Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with the deadline for your income tax proof submission inching closer, here's a reminder for you to make that tax-saving investment if you haven't already done it. And to discuss about it, we have with us Dhirendra Kumar. Dhirendra, let's start today's discussion with a very basic question. What are the key differences between the new and old tax regime, and who should opt for what?
When it comes to paying taxes, there is a new tax regime and the old tax regime. And the new tax regime, as per the government, has become the default thing that will apply to you. The key difference between the new scheme and the new regime and the old regime is that in the old regime you have nearly 70 kind of exemptions possible. Variety of it, mainly what you look at, ATC, the 1.5 lakh rupee which you will invest, that was a deductible, deductible from your income for computing taxes. Likewise, 2 lakh rupees interest paid on home loan. So if you have all those things which are planned with the old regime in your mind, then maybe it makes sense for you to follow. But for everybody earning more than 15 lakh rupee, it gets pretty simple, pretty straightforward, that go for the new tax regime because it simplifies things. It's the government's way of simplifying things, that there is no deduction, there is no exemption, and you have a higher threshold and lower tax rate. But once you cross that threshold, for most people anyway, the new tax regime, they will have to fall. So you will have to figure out one thing, that what suits you best. How is your finances configured? Do you have some exemptions which is possible, which is able to, in the old tax regime, it is able to lower your taxes and reduce your tax outflow. But my sense is that once you cross the threshold of 15 lakh rupees, then you have to go for new tax regime because that is convenient. And that is where, people have to reconcile with the fact that all these years, all these last 30, 40, 50 years, the starting point of all our investment, all our thought process, all our even expenditure has been that where can you save tax,
right,
or how can you save tax, and how much will you, how to compute it. That is something which we have to get out of. Worry about your taxes differently. You can't do anything about the taxes. So pay your taxes, invest your money to maximize your return, and try and earn as much as possible.
So considering that there's some benefit in opting for the new tax regime for someone, is there any way one can still save some tax?
You can, but not in the usual way. You can't make your ATC investment, buy that, invest in a tax saving fund and deduct the investment from your income for computing taxes.
Right.
You can't do that. All you can do is, if you have the flexibility and if your employer is willing to provide you NPS. Because the NPS rule is that up to 50% of your basic salary can be the contribution of your employer, which is a deductible expense for the employer, and it is not a taxable income for the employee, but it is an investment which is going in your name. So you can get that money from your employer into your NPS account and get it treated as, it could be...
It's not treated as your income at all.
treated as your income at all.
Okay. So if someone opts for the old tax regime, what are the specific benefits that one gets out of investing in tax-saving funds?
No, one is very straightforward, that everybody should avail as much of, invest as much as possible to save taxes, because tax saved is money earned. That's one. Second is that why tax saving fund? Because this is the only all equity tax saving investment possible. Everything else is hybrid or fixed income. And fixed income is not going to help you beat inflation even.
Right.
So over the long term, it won't. So you might be very pleased with the safety of public provident fund or any other thing, or the 5-year bank deposit, but it will not make you rich. This is the only thing which can potentially make you rich. Third is that, it's a very nice gateway investment for any Indian investor who has never experienced equity. Because what happens typically is that when you invest in equity, and even if you do your SIP and somebody has told you that markets go up and down, people are not much upset if it is steadily going up. but they're very disappointed if it starts going down soon after you start investing.
And they want to run off.
And they want to run away, and they want to run away forever.
Yeah.
Because that is something which nobody is reconciled with. We make our investment to actually grow it. We don't make our investment to see it nosedive soon after investment. So that is a very scary experience to begin with. And most people, they are getting attracted to an investment simply to save taxes or opportune market. That is a very wrong starting point. What happens with this tax saving fund is that they come with a 3-year lock-in. You invest and you get locked.
Yeah.
And once you get locked, you can get upset, you can feel happy, but you can't get away.
Yeah.
And once you don't get away, you are around, you are bound for 3 years. It ends up being a happy story anyway. And that is what I think, is I'm going to miss the tax saving fund for masses from that point of view. I haven't come across any tax saving fund investor who has been disappointed that he invested his money and he has lost it. And that is not because of tax saving fund, that is because of the 3-year lock-in period. So that is a great thing. And the magic of compounding that happens over a period. So I would urge people that, even if you get into the new tax regime and all that, if you are in habit of investing 1.5 lakh rupees every year, carry on with that habit. Because I was just looking at, one fund, I would not reveal that name because, but most other funds are like that only. If somebody would have invested 12,500 rupees every month for last 24 years, since this fund has been in existence, which means an investment of 36 lakh rupees. This will be worth 4 crore 65 lakh rupees. It is magic of compounding at a much higher rate and with, enforced discipline. So if you're thinking of, if you have no other avenue and you earn 5-7 lakh rupees a year, and if you somehow, are able to invest money in the tax saving fund, which gets stuck for a long period of time, this is going to be a bonanza for you, given that you are disciplined enough not to touch it.
All right, so it's very clear from today's discussion that new regime or old, if you invest in tax saving funds, you will be able to reap the benefits if you invest over a long term. So, but before we end today's episode, we have a viewer's question. Mukesh Roy asks, is it viable to move a substantial portion of fund invested in Nifty index fund, mutual fund to money market fund while market is at lifetime high and then again reinvest it during corrections?
Yes, it will be nice, if you are able to move your money from equity fund or the index fund or any equity exposure to a money market fund just a day before the decline. And once you get to figure out that, okay, now it has fallen and it will start rising again, then put that money into equity again. So if you are able to do it, it will be brilliant, but it's very hard to do.
Yeah. All right, so hope, Mukesh, that answers your question. So keep watching the space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.